three dots in the top right. That allows you to enter full screen, so you can do that as well. It'll give the screenshot just a little bit bigger view. But let's kick things off. So thank you everybody for joining, and I hope everybody's safe and healthy as we get through this Corona madness. But I thought it was a good idea just to give you an update on, a little bit of what's happened, and more so what we're doing from a strategy standpoint, and then also looking ahead to what's going on out there in the world, and things that we can anticipate that are going to happen.
Usually, Matt.
Yep.
I think maybe if people could mute their screen, it might be a little easier to hear you.
Okay. Yeah, if everybody could just could mute. I think I'll see if Jason could mute everybody too, because I don't know if I can from here.
Hey, Matt.
Yep.
Hi, this is Jerry Shen. I'm Jerry and Pat Shen.
Hi, how you doing?
Good, you?
Good.
Good.
There you go.
All right. So let's kick things off here. So when we look at this and we look back at this, and don't worry about seeing the numbers, more the picture that really matters here. Yeah, this is a picture of the S&P 500 since the beginning of the year. Really it's a 6-month view of what's happened to the S&P 500. And the big elements here to really look at are the fact that the drop that we had from February 19th, to basically March 23rd was spectacular. It was the largest drop and largest and fastest drop we had over a short period of time. And the only comparison you can really look at is going back to the Great Depression to see some kind of market moves like this. Then we followed that up with March 23rd, where you had over a 30% move to the upside, which again, in this short concentrated period of time, was the fastest move from a 20% or more greater drop in the markets to a 20% or more increase. So you just had a rapid response in both moves there. And obviously you can see by the level of things, we're not back to the levels that we were, but it's an indication of where things are and how quickly things have moved there. I'll touch on why things reversed there the way they did at that point in time, and exactly why at that date that they moved. But it just gives a an indication again just how spectacular that these moves were. But as we go through this, there's interesting things to look at too. A couple things when you look at investor behavior. Over this period of time, we've had $4.7 trillion go into cash during this period of time, which is, again, just a phenomenal number there as well. But the interesting thing too, when you look back, and we always talk about don't try to time the markets, especially in the short-term moves like this. When you look back in history over any 20-year period, if you miss the 30 best days, just 30 of those days, the 30 best days, then you went from a positive return to a negative return. And when we look at the past 20 years, of those 30 best days, 7 of them occurred in March and April. So it's just a phenomenal, again, what happened, but it also shows that, diving in the middle of a storm like that sometimes can have, bigger long-term implications as far as performance goes. The next thing, just wanted to I think it's always good sometimes when we get into these situations where, the near term is just so volatile to, take a wider view, a longer view of what's really happened. here as well. And when we look at this too, a couple things that, one that unfortunately these type of events do occur over time, and but over the long term, the market tends to recover, all at differing ways, but it tends to recover, and really kind of puts things in perspective a little bit here as well. I showed this chart too because when analysts look at these things and you hear the news and you hear the different stories on the news, some people are talking, oh, it's going to be a V-shaped recovery or a U-shaped recovery, or wondering how long it's going to take for us to recover from this. But I think the interesting thing when they're talking about those things is they've already classified what the event is. If you look back at 2008, the global financial crisis there, that was a true structural market situation where the banking system was greatly harmed, and when you look at those types of situations throughout history, those tend to take the longest to recover. Versus when you look at like a cyclical downturn or an event-driven thing like you're seeing on the chart, 9/11 or the SARS epidemic, Brexit, or the current situation. The current situation, sometimes when people talk about a quick recovery, gets bundled into those, that this is just an event that's happened and we'll get over it like we did with some of those others I mentioned. But I think the one thing that's interesting here is that it has elements of all three of those different events. That there are some structural changes that are occurring, are going to occur. This is an event-driven thing. And it's cyclical to the nature of that we came to the end of an 11-year bull market because of this event. So as a result of that, I think that you're going to see, a little different than a 9/11 or a SARS or a Brexit type, recovery in the market. It may take a little bit more time, and I'll talk a little bit more about that too when we take our look ahead to what's happening in the world. The other thing that got no press at all, which is not surprising because stocks get all the glory and bonds get none of it. But the bond market, to a lot of people, don't realize is really the plumbing that drives all the financial markets. If you don't have a well-functioning debt markets, you don't have a well-functioning stock market. And what ended up happening here is that the bond market stopped functioning properly. Now, how this graph reads is the shaded area, the white line is the S&P 500 that we just looked at. The green line is a US broad bond benchmark. It's most widely used bond benchmark. And just to let you know, I mean, you see that wild volatility swings there, down 33%, up 48% from the bottoms, is that this is a high-grade portfolio or high-grade index. 70% of this index is U.S. Treasury bonds and U.S. government agencies. So it's not a high-risk portfolio. In some ways, the vast majority of this is some of the safest investments, bond investments in the world. And what's happened here too, if you look and see that the stock market started falling first, and then the bond market took its steep plunge. And that's because what ended up happening is that once the stock market went down, it triggered a need for liquidity. And the debt markets are where the liquidity comes from, where the Wall Street firms get their liquidity to do their daily trading, where all firms go to for liquidity, whether it be overnight or all the way out to 100 years. And what ended up happening is it became a cascading effect that people were looking for liquidity. They either had margin calls, excuse me, or they wanted to just raise cash. And by doing that, they were selling their assets that they felt were safer and more stable. So they started going after the things that didn't get hurt first. That ended up being U.S. Treasury bonds, agencies, as I mentioned, municipal bonds, gold even had a one-day sell-off of 8% as people were trying to find sources of liquidity. And this type of market behavior is one of the reasons why we were patient during this, because of rumors that we heard of what was going on, what was happening behind the scenes from the central banks of the world, to address this situation, because the big difference between 2008 being a total structural financial situation where a collapse, yet this was a situation and where they had to basically in 2008 start a whole bunch of things from scratch. This was a situation where the Federal Reserve, central banks of the world had some tools in their toolkit. They just needed to get them out of the closet and turn them back on again. And what ended up happening here is that on March 23rd, that was the time that the Fed announced that, along with other central banks, that they said, we're going to do whatever it takes. And they started pulling out all their tools out of the toolkit, and the bond market basically recovered, as you can see, almost back to its levels. Now, I'll talk about that stocks and bonds are made up of multiple sectors, and not all have behaved the same here, and I'll talk about that when we get into the strategy component. But it's important to see that that bond market recovery, if you look at it, also happened prior to the stock market recovering. So the stock market needed the bond market to be right, in a sense, or right the ship, before that recovery could start to take place. And I won't go into all these, but this is what the Federal Reserve was doing, and what they announced that they were doing over that time frame. So it was a whole host of things. Yes, they lowered interest rates. That was a nice thing to happen. I think that was more of a psychological improvement for investor psyche versus a real financial impact on the markets. These things here that they did truly opened up the plumbing to improve the way the financial system operated. And that was a dramatic improvement that led to that dramatic improvement in the bond market that helped stabilize the markets and gave investors confidence to start going back in. But one thing I will say here, though, too, is that some people have raised this concern, do the central banks, are they out of ammunition here? And the answer to that is no. There's more things that they can do to improve the system if need be. So it was great what they did. It was the most dramatic moves by central banks in history. It wasn't the 2008 scenario where it took time to create these ideas and the tools. This time they said, let's go, and they did it very quickly, which made, again, a dramatic impact. And this is on top of the fiscal stimulus and so forth too. But that brings us to where the bond market is in a sense today. So this is the impact of lowering interest rates by the Fed. On the left-hand side, that's the front end here of the markets. And then you see the markets themselves. These are the various maturities of U.S. Treasuries, considered the safest bond investments in the world. And so you see a dramatic drop since the beginning of the year in overall interest rates. From a financial planning standpoint, this is refinance city here. If you have an opportunity, if you have loans and you haven't refinanced, it's time to refinance. If you have adjustable rate debt, convert it to fixed rate debt. Just today, the 2-year Treasury rate dropped below 0.14%. So if you, meaning if you bought a 2-year Treasury bond now, you'd get less than 0.14% yield or interest on that security. Again, a record low for that. So it just shows what's happened with the bond market. This is just one component of it that happened within the markets themselves. So I just want to touch a little bit on game plan. I'll go through it. I want to go through just a couple topics that we talk about, but just to give a little bit more explanation on things that we do, and then for going forward. So the first thing is we talk a lot about rebalancing, and you hear the term out there. This is just a simple example of what's happened in a portfolio where you get a situation where stock markets fall and your stock portfolio and bond portfolio mix change. So stocks suddenly are less than your target allocation, and then you buy stocks to to bring them back into into balance. And then the same thing happens, in other situations. If the stock market goes up, your stock position gets too high, so you, in a sense, buy bonds to bring the allocation back to your target level. So there's a couple things. Some firms just automatically, and now there's so-called robo-advisors or ones that are all automated, that they automatically will rebalance on a monthly basis or when certain target thresholds are met. And I think that's fine in some ways, but I think history has shown and research has shown that it's important to, like we have, as a systematic review. So we look at this all the time. Our trading system alerts us on this to opportunities that exist, but it's not something that we have to do or automatically gets done, because it's important to look at the situation. And this past one was really important. Whereas some situations we're looking at, or some firms that just automatically did it, were rebalancing right into the eye of the storm here. So it was inefficient. They weren't really accomplishing what the goals are. We remained patient through this because, one, as I mentioned, we needed the bond market to heal first before we saw this opportunities for rebalancing. It's why we rebalanced in the beginning of April as opposed to right at the mid to second part of March period. But as I said, we look at this on a regular basis and look for opportunities. And if it's done right, if you really look at it from a managing risk standpoint, it can have some decent long-term benefits when you look at it. Here's just an example of how that really plays out over time, and looking at that and research we've done on it and how we do it. It can really lead to an improvement in performance over time, which is the nice outcome. But it's that double attack that you can have, where you can improve your overall performance and lower your risk profile within the portfolio. Because in our situation, the planning determines what your risk tolerance is and your asset allocation, and it's important that we maintain that throughout the various cycles that we see. Another thing that we talk about is tax loss harvesting, and this is just a simple example where you have a position that had a $30,000 loss. You basically sell that position, purchase a very similar security, and then as that's secured, so you don't lose your exposure in the market, you've recognized that loss that you can use from a tax standpoint. And then you see over to the right there, basically if that position came back, improved by 30,000, or by 22,000, I should say, you can use some of those losses to offset those gains. If there's any additional losses, or if you've used them all up, you can carry those losses into future years. And you can also use 3,000 of losses a year against ordinary income. So it's an interesting tool to be able to use out there to help improve your after-tax performance within a portfolio. But it's something similar to my comments about rebalancing, is that it's not something you have to do all the time. It's something where you look at these, we look at these opportunities throughout the year. Because again, if you look at the way the markets behave, they go up and down. Having multiple 5% drops in the markets every year is normal. And even to have a 10% loss in any year, happens 80% of the time. So it's not unusual, but we look at this on a case-by-case basis to see if it makes sense to do this. If the position that's down, is it something that will quickly bounce back, and it's a position we really like. So we have flexibility there, but it's something that you should see, that you potentially could see us doing throughout the year when we look at portfolios. And it really does have a compounding effect over time on returns. It can make a dramatic improvement in overall returns within a portfolio if it's something that's incorporated into a portfolio strategy. The other thing is, we always want to look ahead. The one thing I think that it's a weird concept, even if I'm, me for doing it every single day, is that the markets are forward-looking entities. Yeah, so that really matters, and sometimes I think it makes it look like it's confusing. Today's a classic example. 3.3 million more people applied for unemployment claims today, bringing that number to over 30 million. So that to me is like, why the heck would you buy any stocks on a day like today? It's because the markets are looking ahead all the time. There's debate whether how far ahead it looks, but in a simple term, it's really saying, do you think the market 6 months from now is going to be better than it is today? And if you do believe that, from an investor standpoint, you would be buying stocks now to take advantage of that, and that's what's happening. Today, over the last couple of days, you're starting to get earnings reports from corporations, and they've been better than anticipated in some ways. And also, the economic numbers too have been not as bad as expected. And the other thing to keep in mind too is that investing too has a big human element to it, and that big hope. You basically you buy an investment because you think that it's going to do better, and you add money into a portfolio because you think things are going to improve. So those things really play a huge role in how the markets work. So even on a day like today, when the economic numbers don't sound as great, in the near term, over the longer term, they do look positive. So the market's up over 1% today. But let's get into, again, looking ahead here too. And don't worry about digging into the into the numbers or seeing the numbers. All you need to do is see the colors, because red means that this is the forecast for the global economy. Red means that there's negative growth here. One thing that is for certain is that in March we went into a recession, not just in the U.S. but globally. Obviously, you can see a couple of spots here where growth is still hung on. And the forecast is that for the year they can have positive growth. But I think you'll get it out there is that yes, 2020 is not a good year. I listened to earnings calls from corporations, and none of the big corporations are forecasting 2020 earnings, which they normally do. It would be a normal operating procedure among an earnings call. But all of them are saying it's just a great unknown. So they don't want to dive in and make that prediction of where things are going. But when we looked at 2021 now, the forecast obviously changes pretty dramatically. Where you have the Sudan and Venezuela as the only ones with projected negative GDP growth, whereas the rest of the world is expected to bounce back. And some of these numbers are pretty dramatic bounce backs. So we will see how this plays itself out. But to summarize how that looks, when you look at the global economy there, 2020, prior to this COVID outbreak here, was projected to be a little over 3% growth. And now it's projected to be a negative 3% growth. So it gives you an idea of where things are. But when we come to the markets and we're looking at these type things, it's really how closely are these estimates, these projections to reality. And that's going to be an important thing to see here. This isn't talking about the, how quickly, other than, year to year, but it does show that there is a great potential for a significant and strong rebound. And it's part of the reason why you're seeing the markets have this strong response post, March 23rd. But I wanted to spend some time too on just strategy, and first to give you an idea, how we think too, because that's important. We really break it up into two different components: a strategic outlook, which really has a 5-year horizon. We look at our projected returns in various sectors. We're looking at long-term things, as far as disruptions, where you see permanent disruptions to sectors or permanent disruptions to growth. And building assessments off of that. This is something that this current situation affects, but at the same time, we don't change our overall strategic outlook in the middle of a storm. But we are now looking at ways that where there's permanent change to what's going on. That structural change that I mentioned in the beginning, is very important for that. And then we also, take that tactical view. What's going on? What do we think is going to happen? On a longer term, on a shorter term type situation where we have, trading opportunities, dislocations in certain markets. If a certain strategy that we're involved with, a certain manager we're involved with, is not working, then we want to make those, tactical opportunities, take advantage of them. So what's happening here from a portfolio standpoint, it's kind of interesting, is that for people who have more conservative portfolios or have more of a conservative risk profile, the odd dynamic is that there's a lot of bond sectors now where we came into the year and we're saying it's going to be a real struggle to find opportunities out there. Now there are, a reset of interest rates and yields that are out there in a lot of different categories. So without taking a ton of risk, you can improve the income and the return out of the bond portfolio that didn't exist at the beginning of the year. Obviously, we have better ways to get there than that. But there's interesting opportunities where you don't have to stretch out into other bond sectors that are more risky in order to get a reasonable return. And I think that's a really important thing to do. And some of the odd things too, and some of the cash components too of portfolios, there's opportunities there as well where there's some dislocations. So oddly, even though the Fed has dropped interest rates to basically zero, overnight interest rates, that there are still some cash-like opportunities out there too, from the bond market, that we've looked at and had already incorporated into the portfolios. And now I think we're going to get more return out of those components than we had originally thought as well. But the flip side is where some tactical dislocations. Municipal bonds, thanks to some of the scares that about what potentially could happen to states and cities here and whether aid would come or would not come. Looked into that quite a bit too, that the federal government cannot make the states go bankrupt. That's illegal, and I don't see that happening anyways. There are obviously parts of municipal bond market that are riskier out there, and rightly so, have sold off. But some of the higher quality stuff has now kind of repriced to levels that are again very attractive. Same thing for investment grade or higher quality corporate bonds have repriced. So there's good opportunities there. And then for people who like to go out on the risk spectrum, they're just sticking in the bond market, high yield bonds and other riskier investments, emerging market bonds and so forth. They have created wide opportunities as well there. So there's, in a sense, something for everybody as far as the bond side goes. And then we flip to the stock component. We look at there's certain stock markets or sectors of the markets that have not seen that rebound that we've seen in some of the U.S. markets. So there's places that have lagged behind, and rightly so. The stock market is behaving efficiently from the standpoint that riskier sectors, riskier investments are not performing as well and are lagging behind, versus the ones that are in quality. But as I showed you from that first chart, that there's still opportunities out there. A nice thing to do, that look at and things that we've been incorporating is, up in quality, solid dividend payers, those type of things. They went on sale, and it was an opportunity to look at those and capture some of those things. Some of those companies that are going to benefit from the change the way you and I behave every day, too, are important things that can add into the portfolio. But just like the bond side, there's stock opportunities out there as well for those who were looking at some of these higher risk areas. And that can be things like even just U.S. small and mid-sized companies, that they have lagged behind some of the others. There's some sectors outside of the U.S. That have lagged behind as well. to give that are opportunities to look at, but it really varies. But I think the outlook has really, almost given us a reset as far as, potential opportunities. When I talk about our strategic outlook now, some of these areas now we've increased our potential return in some of these categories too, which is, again, helps us adjust our mindset as far as, building the portfolios. But I think bottom line is that it is uncertain. The markets, the stock market in particular, is going to trade off of, three main things right now. Number one is going to be vaccine news. So vaccine news is going to trump everything. And we've already seen a little bit of that today. Actually, we're seeing it in European markets today as Moderna is talking about progress on their vaccine in France. And number two is going to be, the health situation, the number of cases flattening the curve, this experiment of opening economies, what that's going to mean. And then oddly, it's all flipped on its head, as economic fundamentals would go third here. Normally, economic fundamentals would be number one, but economic fundamentals are going to take a back seat to those other items. So there's going to be days where you're going to see economic news come out and you say, why isn't the market moving on that? It's because those other things are trumping it right now. And I think that will change over time, but for now, that's the main thing that's going to drive these markets, and seeing again how this all plays out. So it's volatility has been high, it's come down. Volatility will still be above average levels for a while now, which is good and bad depending on the situation. But it's something that, although we've calmed down, as I tell people, keep the seatbelt buckled, because it's going to continue for a while longer here as we get through this situation. But I also wanted to open it up for questions, for people who have questions. As I said, you can message them here. I'll look in and check the comments here. So in the chat, you can use the bubble and chat in. The other thing is, you can reach me anytime, email, call anytime if you have specific questions, or call anyone, in the office if you have questions, regarding this or specific things that you're looking at.
Hey, Matt, it's Jason.
Yeah.
We do have a couple of questions. Can you comment on the potential effect of the upcoming presidential election on the global economy?
Yeah, so things have changed. That quiet little election while all this has been going on. So one of the things that we were looking at too is when it was unknown, who was going to go, Trump versus who. We took a look and said, okay, let's look at the potential outcomes here to the markets, and both globally and domestically. And the interesting thing to look at is that we went back in history, and no matter who was elected, the markets were not affected. The markets went up. And that surprised me. I thought that you would see a different outcome there, but a lot of it has to do with, when you broke it down, is that elections come, people have hope for change, and that we would see a improvement in our lives, based on a new regime in the markets, in the office. The other thing too is that now that it looks like Biden is the presumptive Democratic nominee, that's changed even a little bit more, because there's thought that if there's a Bernie Sanders or maybe others, there might be some more volatility. Some of the volatility projections were a little bit higher, and some of that's come down now. And so I think that from a markets perspective, the markets are kind of saying we're happy with either outcome. And when we look at the the global markets, I think it's one right now is talking to strategists who are based in other regions, that they're looking at a Biden victory being better for the global markets than a Trump election, and that's all subjective too. We'll see, but I think that what we'll see is a period now that everything's kind of up in the air. There's not the conventions, which usually you see volatility around that. I think next time, from a market moving standpoint, look to late September to mid-October as being a time where volatility will pick up because as we get closer and closer and uncertainty peaks.
Thanks. Next question is, what effect do you foresee due to the $3 trillion increase in the federal debt?
Yeah, it's one of those weird things. It's like, we just borrow forever, and there's no ramifications. So I think in the near term, we'll see no effect. Even looking at, because if you look at that one graph that I showed you of the bond market, I mean, that was one that's, unusual that you would see in a situation where supply, in a sense, is coming out. You would see longer term interest rates go higher. And they haven't, because of the fact that there's just so much demand for safe investments. And that's keeping interest rates under control, because people are rushing to the safety of U.S. Treasury bonds, to overcome that supply right now. But it's not something that's sustainable. We'll see. I mean, there's some economists that have this modern monetary theory, which believes you can borrow forever and continue. But history shows that that's not sustainable. But we'll see. I mean, it's hard to project what the day, when the day of reckoning is of too much borrowing to see. But on a side note to that is that corporations now, from their debt standpoint, they have really improved. It's a huge difference between 2008 to today. One, they have huge cash hoards. Most corporations do at record cash levels still, and they refinance all their debt over the last 10 years. And they've even been refinancing their debt through this crisis. There's actually this quiet little thing's been going on too, that corporations, again, have stockpiling cash. They've been issuing bonds at record numbers. March and April had the largest issuance of corporate debt in U.S. history. So they're saying, okay, interest rates are very low. This may not last forever. But it was an opportunity to improve their balance sheets and then raise cash while they could. And that was another reason why I say it was so important to fix the bond market.
And I would just add to that on another level, the effect may very well be increased income taxes in the future, as the country has to pay some of that debt back, which will affect everyone's financial plan. The last question we have right now is that gold has been mirroring stocks. Do you expect that to continue? Yeah,
it's been, gold has been sleepy for a while, and then suddenly, this crisis woke it up, in a big way. And, it really has to do with, because remember, gold is not just something that obviously we wear, but I mean, from an investment standpoint, it's also something people use for stability against, weakening dollar, oil values going down. So you've seen a real surge in gold demand, and it's also, even though countries don't necessarily, publish that they use gold, a gold standard for their currencies, they do also use gold for protection against their own government inflationary numbers and stability of their foreign currency reserves. So and that's another thing that's quietly happened here, is that there's been large movements of gold to countries over this period of time, over the last 3 months here as well. So it's something that gold prices, it's all about supply and demand. And demand is really high right now. We'll see, and that's going to really, that correlation with stocks is really going to continue until we get better hopes on handling the medical side of this crisis.
Okay, that's all we have for questions.
All right. All right, thanks. I think it's a new world. We'll look to do, more of these, and, as we go through time, and look to communicate a little bit more, and through the use of video going forward. I think it's going to be, an effective means. It's nice we had this stuff in place ahead of time. It's come in very handy through this. But, thanks everybody for listening. And again, if you ever have any questions or follow-up, please message any of us.
Thank you.
All right.
Thank you, Matt.
Bye, thank you.
Bye-bye.
Bye.
Thanks, Matt.